Good morning. I'm Gord Long with the Financial Repression Authority. I have Graham Summers, Chief Market Strategist with Phoenix Capital Research, joining us this morning. Welcome back, Graham.
It's a pleasure to be here, Gordon.
Graham, it's nice to have you. I enjoy very much all of your missives you send out, and I highly recommend them to any of our listeners who haven't been following your work. Graham, maybe we could begin with you giving our listeners just a very brief overview of what your personal involvements and Phoenix Capital Research, more about the company.
Sure thing. My name is Graham Summers. I'm the Chief Market Strategist for Phoenix Capital Research. We are an investment research firm based in Washington, D.C., in the Washington, D.C. metro area. We have clients in 56 countries around the world. What we specialize in is investment research that is sold on a subscription basis. So people buy a subscription to our research. We do not manage funds. We do not broker deals. So the only way we stay in business is if we make our clients money by telling them what to do. And we've been in business since 2009. We've done very well, and it's a pleasure to be here.
Well, thank you, Graham. And I guess on what you just said, I notice in your missives, because you're more times than not saying what others are saying in the market.
Yes.
You're actually calling out the bad news before anybody wants to talk about it. That's my observation here.
Well, we live in a very strange world today. Because everything is so kind of delusional, if you're a realist, you're considered a perma-bear. I don't understand that personally. If you applied that mentality to, say, your physical health, we'd all be sick and almost dead, but we live in a world that's very illusory right now in terms of the financial markets.
Isn't that the truth? You've consistently talked about subjects that nobody was talking about and then become front and center and been warning on them. So let me just jump right into this because I know we're always short of time. Japan's announcement of negative interest rates and what that means to the U.S. dollar. You had a great missive explaining the serious ramifications of this.
Well, we need to provide a little context as to why Japan matters. Japan is at the forefront of the kind of Keynesian central planning that's been in the markets for the last few decades. What I mean by that is that the Federal Reserve first went to ZIRP and launched quantitative easing in 2008. The European Central Bank, they went to ZIRP a little bit later than that, and they launched QE in 2015. The Bank of Japan first went to ZIRP in 1999, and they launched quantitative easing for the first time in the year 2000. So they're almost 2 decades into what the kind of grand experiment that the Federal Reserve and the European Central Bank just began. So they're at the forefront of these things. So they have the most experience with seeing just what those sorts of policies can accomplish. And the fact of the matter is they can't accomplish very much at all. But when you're a central bank, your job is to maintain credibility in the system, not necessarily to always make the right decisions. I myself have been very critical of central banks. I'm just describing how these guys operate. So the big news from Japan, to me, was not really NIRP, but it was what happened about a week or two before NIRP was announced. And what that was Kuroda, the head of the Bank of Japan, came out and announced it was sort of nestled in a speech he gave, that Japan's potential GDP growth is 0.5% or lower. Now, for those of us who know how to sort of read between the lines when these guys talk, this was an absolutely astounding admission, because what he was doing was he was implicitly admitting that no matter how much money he prints or what monetary policy he engages in, Japan's GDP growth cannot break above 0.5%. I mean, from a psychological perspective, this is incredible. This is like a central banker saying, we don't have the tools required to generate economic growth. I mean, it's like seeing a doctor and the doctor telling you no matter how much medicine you take or treatments you take, you won't possibly get better. And it really, to me, shattered the kind of aura of impotence that we've had around central banks since the crisis in '08. Now, the markets didn't really catch this because most people don't see what is actually happening. They usually see what they want to hear. But that admission to me was absolutely staggering, and that was the sort of beginning of the end. That was the end game commencing for Japan, which, as I mentioned before, is ahead of the Federal Reserve and the European Central Bank in terms of policy. So it wasn't too surprising to me that shortly thereafter, when the Bank of Japan went to NIRP, the market reaction was actually terrible. Because when you reach the end game for central banking kind of omnipotence. What you're really talking about is a time in which there are no longer positive results from central bank policy. There have always been negative results. As far back, anytime you cut interest rates, anytime you launch quantitative easing, there's always going to be negative consequences as well as unintended consequences. The one positive consequence that you could sort of point to since 2008 was that whenever one of these policies was launched, stocks went up. That was ultimately the one thing you could really point to. And in fact, Bernanke himself did with Congress. He said, well, stocks are up, so it's working. Because the reason that he admitted that is because he knows, and they all know deep down, what Kuroda himself finally went public, which is that none of these policies really generate economic growth. They're all about the bond bubble. But I'm getting ahead of myself. So when Kuroda launched NERP, and he had reached the end game, and what I mean by the end game was the positive aspect of that policy, which would have been Japanese stocks rising, only lasted about one day because he did this on a Friday, and by the next Monday and the next Tuesday, the Nikkei had actually collapsed. And it's currently down, I think, over 8% from when he did this. So the positive aspects or the positive consequences were no longer there. The negative aspects, however, were there, and they were there in a really big way. Namely, and nobody seems to have caught on to this, Japan had to cancel a bond auction because of lack of interest, which has never before happened in history. What that basically is saying is that Japan was not able to sell its debt on the markets because investors did not want to buy Japanese bonds at a negative yield. Now, that's absolutely incredible. So let's just take a 20,000-foot kind of perspective on this, the big picture. A central banker admits implicitly that he does not have the tools to generate economic growth. He then launches negative interest rates for the first time in the history of his country. Stocks don't rally, but instead roll over and collapse, and then his country is unable to issue debt into the markets. I mean, this is completely unprecedented, and few people are really catching on to it, but for me, this is the beginning of the end.
Graham, and then taking that the next step, those who see this, what does this mean to the U.S. dollar vis-a-vis money out of Japan?
Well, the issue we're dealing with right now, and this was kind of always going to be the issue, is that when the crisis hit in 2008, the central banks around the world all coordinated their response. But the problem with that is that their policies we're in a fiat world where everything's relative. So all of their policies consist ultimately of kind of currency debasement with the idea of inflating away debt payments, that is making debt loads more serviceable. But the problem with that is that every time somebody launches something, it has an adverse effect on the currencies against which their currency trades. The most obvious example of this is the European central bank and the euro vis-a-vis the U.S. Federal Reserve and the dollar. The euro represents 56% of the value against which the dollar trades. So if the ECB does something that pushes the euro down, it's going to naturally push the dollar up. So when the Bank of Japan went NERP, you've now got both the European Central Bank and the Bank of Japan employing NERP. This should be very dollar positive. What it's actually doing, though, because we live in such a screwed up world, is that for years, hedge funds have been betting very large leveraged bets that are shorting the yen and going long the Nikkei. When the Bank of Japan implemented NERP and that situation happened that I mentioned earlier, the negative consequences, that trade began to blow up. The yen started surging and the Nikkei collapsed. What that has done is forced a lot of institutions and hedge funds to start liquidating their positions. Because when you're using a lot of leverage, as soon as a trade goes against you to any significant amount, you blow up very quickly. So that's what we're seeing right now, actually, is the yen is soaring and the dollar's falling as a result. That's not based on any fundamentals. That's just liquidity sloshing around the system. From a kind of global perspective, what the Bank of Japan did should be very dollar positive, and I believe it will be proven to be the case down the road.
Yeah, that's what I'm wondering. So maybe this is transitory. It'll work itself out, but it's going to be then a very, very strong push for the U.S. dollar going forward.
Most likely. If you want to look at the world...
Yeah, if logic prevails, but as we know, it's so convoluted out there.
Well, there is logic and there is the reality, and that's going to be what slowly unfolds. The short-term fluctuations are based on what traders' expectations of central banks are. We're in such a central planning-oriented world right now that what's been driving markets in the short term is perspective on what central banks are going to do. because central banks were just broadcasting policy in advance. If the Federal Reserve or the European Central Bank is announcing, hey, I'm going to be buying these bonds in a few months, everybody's going to pile into the bonds. And if you actually look at, for instance, treasury yields, the yields fall the most once the central bank starts hinting at a policy. When the actual policy is launched, the yields usually rise. That's because traders and investors front run central banks, and then it's a classic buy the rumor, sell the fact. And that's what we're dealing with right now. So short term, you're going to see these kinds of spikes. Bigger picture, long term, my view is that we're in a multi-year dollar bull market. This is because we're in a cycle of deleveraging. And if this happens to be, the cycle of deleveraging, the one that everyone's been expecting for decades, then the dollar is going to really surprise a lot of people to the upside.
It's our view that the credit cycle has turned. It doesn't turn off, it's turned in a major way. And we can see all sorts of evidence of that, for example, in high yield spreads, et cetera. And you've been talking about an implosion in the bond bubble here for quite some time. And what we're seeing already in, for example, distressed debt. Comments there?
Yes, that's exactly what's happening. But people need to understand, when you have a bubble burst, it is not a rapid thing. If you look at the NASDAQ tech bubble in the late 90s and in the 2000s, that bubble burst. That bubble was isolated primarily to one asset class, namely stocks, and specifically one sector, tech stocks. Of course, there were mispricings elsewhere in the market, but that was really a pretty isolated bubble. It just was a very, very extreme one. And it was only about 16 trillion in size. Well, in spite of that small size, let's say, for a bubble, the market was an absolute roller coaster where you had 8 price moves of 16% or greater in a 6-month period before we really took out the trend line that indicated the bubble was over. And it took another couple years for the market to bottom afterwards. So what I'm trying to say is that if you have a bubble in a single asset class that took roughly 3 years to hit bottom, and we're now talking about a bond bubble, which is the bedrock of the financial system. It's over 100 trillion in size. This thing's going to take years. It's not going to be that the bond bubble bursts and in a month or two it's all kind of settled. It's going to be a long-term deflating, and it's already begun. The first wave was the high-yield the high-yield bond market, which has already taken out its bull market trend line and has begun to implode. But it's also going to feature emerging market corporate debt defaulting, and it's slowly going to, one by one, each foot's going to fall until finally you get to the sovereign bond defaults. But it's going to take months, if not years. This isn't going to be a kind of overnight thing. It's going to be a roller coaster ride down. It's going to be one asset class blows up. I guess a great way to look at it would be look at what happened in oil. You had a 60% price collapse in about a 6-month period starting in 2014. But that mess is still kind of unfolding now. But that was really the bond bubble. That was the junk bonds in the energy sector blowing up. So I apologize if I'm kind of doing this in a long-winded way, but my point is the bubble we're dealing with right now is the bubble. This is the crisis to which 2008 was the warm-up, and it's going to take a lot longer to unfold than people think.
The slow, consistent, cascading approaches that washes or moves all the way up the risk curve.
That's exactly right.
And so that's what we can expect. It's going to be protracted. It's going to hurt a fair bit. You've talked extensively, I know, about the problems in China. You've talked extensively about oil and commodities, and I'll refer our listeners to a lot of your research there. But now what's emerging is this, in parallel with this, is European banks and whether the U.S. is going into a recession and the ramifications with that. Comments on the European banking situation right now?
Sure. Well, Europe is a strange place. They never really engaged in any significant reform. Their entire banking system almost collapsed in 2012. Very few people seem to understand just how bad it got. We're talking full-scale systemic collapse almost hit in 2012. And Mario Draghi, the head of the central bank in Europe, pulled a rabbit out of a hat by saying that he'd do whatever it takes to save the euro. And that kind of reinstilled confidence for a lot of people, and they bought themselves 4 years of a kind of rebound of sorts. It's not really been a recovery. It's just been a rebound in the sense that European yields have fallen, which makes the debt loads more serviceable. But there was no structural reforms. The banks weren't raising capital. There weren't debt restructurings. Everybody just continued partying like they were before. It's almost like you had a house party and somebody yelled, "The cops are here," And someone looked out the window a minute later and said, "Oh, actually, they're not here." And everybody just went back to partying. And that's basically Europe the last 4 years. And so what we need to do is just look at the basic facts. European central banks taken as a whole are leveraged at 26 to 1. These are just the formal numbers that they report to the IMF. So if you're leveraged at 26 to 1 and you have a 4% drop in asset values, you've wiped out all equity. You're insolvent. And I'll refer your listeners to a little fact most people know. Lehman Brothers was leveraged at 30 to 1. So if your entire financial system is only a hair's breadth away from Lehman levels leverage, and you're not rapidly restructuring and looking and using low bond yields to refinance your debt loads, you're going to get in major trouble. And that's exactly what's happening now. The European banks are once again under duress. This is due to a number of things, but most of all, it's the derivatives markets, of which Deutsche Bank has the largest derivatives book in the world. But ultimately, what this all brings us back to is the bond bubble. Bonds, specifically sovereign bonds, they're the bedrock of the financial system. Those are the senior most assets that sit on banks' balance sheets. That is what they use as collateral, the senior most collateral for all of the derivatives books trades. So if those sovereign bonds are starting to get increasingly volatile due to NERP, you're going to start seeing derivatives trades blowing up, and that's what the markets are smelling with European banks right now.
Is that what's going on? You mentioned Deutsche Bank. Is that the canary in a coal mine with their trillions of dollars in swaps?
Yeah, I mean, a lot of people are seeing Deutsche Bank as this new development. If you look at Deutsche Bank's 20-year chart, the thing is one of the biggest head and shoulders you'll ever see in history. I mean, the stock is already over 90% off its all-time highs. It's just finally it's really starting to collapse and accelerate. But yes, it's the derivative problem. It's the fact that since 1999, the derivatives markets have been largely unregulated, and this has been because central banks have permitted them to balloon and grow out of control, and that's coming back to bite us. It bit us first in '08 with credit default swaps. That market was about 50 trillion in size. The interest rate-based derivatives market, so the derivatives that trade based on bond yields, that's 555 trillion. So we're talking about something that's roughly 10 times the size of 2008. That's what's begun now.
You mentioned the European banks at ratios of 26 to 1. Reggie Middleton believes that it's somewhere north of 55 or 60. Do you think it's even higher than reported?
Oh, obviously. I mean, the numbers I got are from the IMF, and they're always conservative when it comes to risk, and very liberal when it comes to growth. So I wouldn't be surprised. 50 to 1, 100 to 1. It's no one knows. This is really the ultimate problem. It's a crisis of credibility. Nobody knows what these guys own. It's the bank balance sheets are like black holes. It's impossible to analyze. That's why it's so crazy to me when I see people saying, "Oh, well, this bank stock's undervalued." You don't know that. Did you actually sit and go through the 5 million pages worth of derivatives books that they own? No. So you don't know what they actually are worth.
And that's the trouble with the approximately $700 trillion swaps market that's all over the counter. There's no real way of knowing what's inside it unless you're an international bank and have part of it.
Yeah, and even they don't know. I mean, this idea that these are the smartest guys in the room and they've got their finger on the pulse of the world, they don't know what they're doing. I mean, everybody figured that out in '08. What happens is everybody's willing to trade with each other based on the notion that central banks are bank stopping them and will nationalize any losses they experience. But eventually, when you're trading garbage, trading garbage that you're claiming is something else, eventually somebody's going to say, "Wait a minute, I think this might be garbage." And that's what happened in '08. That's what's happening now. Is you're actually starting to see counterparties wonder what is the true value of the assets that are being exchanged on these illiquid kind of unregulated markets. And as soon as that crisis of confidence begins, it ripples throughout the financial system.
I can remember Chuck Prince, head of Citigroup, prior to the 2007 crisis, people expressing lots of concerns, and he shared them, but he says, you got to get up and dance while the music's still playing. You got no choice. And then it imploded right in his face. And I think a lot of this is they're trapped in a game for those who do understand it. But switching gears, if I could, gold is broken out here dramatically.
Yes.
And we're seeing something we haven't seen in numbers of years here. So the question, Graham, is this a bear trap? Is the powers to be that have clearly been manipulating the physical going to step in and do another hammer here, or is this time to get in?
Well, it's very hard to analyze those sorts of things. You can't predict what the central banks are going to do. What you can do is look for large-scale shifts in investor psychology. And that shift appears to be occurring in gold. So gold was in a bit of a bubble in 2011. I know a lot of gold bugs hate me for saying this, but it's just simply it was so far overextended above its overall bull market trend line, you were going to see a kind of collapse. When you combine that collapse with central bank manipulation and the effort to suppress gold, you're going to see an asset class really have struggle for years to sort of find its legs again. But what's interesting is that since China devalued the yuan back in August, September, gold has begun to outperform stocks. And since Japan went to NERP, this process has accelerated dramatically. So what's caught my attention is that it appears for the last, say, 6 or 7 years, investors were loading into stocks as a hedge against central bank policy. And gold also, benefited from that. That trend reversed starting in 2011. Investors continued to use stocks as a hedge against central bank policy, but they abandoned gold. Well, that seems to have reversed. Investors are now moving into gold as a hedge against central bank error, and stocks are suffering. The reason gold's having such a dramatic move is the gold market is so much smaller than stocks that when you start seeing large-scale chunks of capital moving into gold and gold ETFs, the price moves are really dramatic. And in fact, I think it was the Telegraph commented that one of the gold ETFs saw the single largest day of capital injections in history. So investors are piling, and whether or not this is the next leg up, I don't know. What I can say is that whenever the next leg up really does begin, and we're only going to know that after the fact. You can't predicting what's going to happen is it's I mean, it's very difficult to be very specific about what's happening right this second. You can only after the fact really see clearly when the turn point was. But when that next leg up does begin, gold will really, if we're using the 1980s as a proxy, gold is really going to explode higher. It was the second leg of the gold bull market we saw previously where gold really erupted higher. And that's my view this time around. If this is really the next leg up, 2,000 gold is going to seem cheap. You're talking 4,000, 5,000. And if they actually decide they're going to use gold again to value currencies when the big reset hits, 10,000 gold, who knows? It's going to be very high.
When I see some of the banks even entertaining buying gold, which I saw here last week, that tells you that something dramatic is beginning. And I share your point. You never really know until later. So looking at how a lot of bad news here, can I kind of conclude that U.S. Treasuries, cash, and precious metals are probably the place to consider in 2016?
Yes. What we're dealing with right now is a kind of flight to safety, and that safety is currently being perceived as the U.S. dollar, treasuries, and gold. But that may change depending on how the Fed reacts. This is the problem with these kind of long-term forecasts right now, is at some point a central bank hits panic, and then you have to adjust your analysis to look how the theme's driven. The big picture I've been seeing, and it started in 2014, is I believe the U.S. dollar has entered a long-term bull market. That bull market is going to be overall very positive for the dollar. Treasuries will also benefit because as different bonds blow up around the world, whether it's emerging corporates or high yield junk, you're going to see capital flowing into treasuries because regardless of the U.S.'s financial situation as a country, treasuries are still viewed as kind of the ultimate risk-free money in the world. And then in terms of gold, that's a really tough one because the central banks really hate that as an asset. So you're talking about always the chance for manipulation. But as I mentioned before, starting in August of 2015, gold really started to catch wind. I've been looking at the chart. It looks like it's back in that falling wedge pattern. What's interesting is that the gold mining juniors have actually just poked their head above the trend line. So it looks as though the junior miners are really starting to show indications that the next leg up is here. But again, it's a little early. But yeah, overall, if you're looking at the simplest way of looking at the world right now, dollar's looking good, treasury's looking good, at least for say until the Fed panics again. And gold is looking good too, but again, that depends on how central banks respond.
The one thing I do know is never underestimate what central bankers and government will do when they're in a corner.
Absolutely. I said in 2015 in April, NERP is coming to the U.S., and everybody said, well, that's crazy. The odds of that are less than 1 in a billion. And I said, well, as low as those odds sound, those odds are a lot better than the odds of all the central banks saying, hey, you know what? We don't know what we're doing. We're all going to quit our jobs and just see how this turns out.
They will come up. I just know that I think we're probably in the third or fourth round of a 9 inning of bizarre kinds of policies that we're going to see in attempts to salvage a dam that's starting to crack and is evident everywhere. And that's going to create huge volatilities, and even logic, you're going to find yourself caught on the wrong end of some trades.
Absolutely. You got to make sure you don't get Volkswagen, which is that's that thing where you're correct on the trade, but you just can't take the pain.
That's my sense of what we're in front of us in 2016. We talked about cash. Do we have a war on cash going on in the developed markets?
Yes, absolutely. You're seeing this everywhere. The goal overall, so part of what caused 2008 is that you started seeing investors pulling money out of the money market funds by the tens of billions. I think it was roughly 25% of the money market funds in the world tried to be liquidated in about a 1 month period. Excuse me. Excuse me. So cash is a real problem for central banks. They can't control it. You know, if a significant amount of investors try to pull their money out of a bank and move into physical cash, then the bank would very quickly implode. I'm not saying people should go start a bank run. I'm just saying that's just the math. It's just how it works. So cash is a real problem for central banks, which is why there's this really intense campaign underway to try to destroy it. The way they're going to do that is they're going to have interest rates at very aggressive, punishable levels, whether it's NERP or ZERP, and they're going to start seeing physical cash being banned from certain transactions. You've seen that showing up in some countries in Europe. Uruguay's done it. That's going to be coming everywhere. And in fact, J.P. Morgan, I think, put out a missive last year. They don't want investors sitting in large. They're not going to accept large deposits of cash anymore from institutions or from corporates. And finally, you're going to probably see cash either being outright banned, or you're going to see a carry tax, which would be some kind of system where if you take money out of a bank into physical cash, the cash begins to lose value. They'd probably have some kind of, I don't know, magnetic strip or some record that would notify that the bill has left the system, and they would immediately start devaluing the value of that bill. And so that, say you go return the bill to your bank, say 2 months later, it's now worth 95% of what it was before. And all of this was actually laid out in 1999 in a paper that I've actually gotten a hold of. And it basically says, if a crisis ever hits and central banks find that zero interest rate policy is not getting the reaction they want, they can do one of three things. They can impose carry taxes on physical cash. They can engage in large-scale quantitative easing programs, which we've already had, or they can actually start doing direct money transfers, which is the so-called helicopter money, where it's not QE, it's just simply giving money right away into the system. Let me clarify that. Quantitative easing, you're printing money to buy an asset from a bank, and that's supposed to provide liquidity. Transfers would be you just print the money and just give it to the bank. There's no transaction involved. So this was all laid out in 1999. It sounded completely bonkers then, but most of that's already come true. And what I would remind people is that most of the things that sounded completely insane even 3 years ago are now commonplace, whether it's negative interest rates or quantitative easing or what have you.
How quickly we adjust to the bizarre and accept it as the norm. Isn't it amazing?
Well, if you look at the economy as a kind of pyramid with the central governments and central banks at the top of that pyramid, there's such an aggressive campaign to maintain that structure, and the media, for the most part in this country, due to career risk, are just shills. And that's not just in the U.S. That's everywhere. Financial media is generally just a bunch of paid cheerleaders that their job is to sell eyeballs to advertisers, not to sell investment insights to anybody. If that's the case, you've got a very aggressive campaigns trying to maintain a kind of view of the world that isn't really going to work. People are going to adjust pretty quickly. They're just going to start saying, oh, well, this is normal. What 5 years ago seemed completely insane is now just how it's going to be.
Graham, we're nearly up against our hard line here. When you get into situations like this, you really have to worry about counterparty failures. They come out of nowhere, and then you get contagion. But last time we had you on, we never got a chance to talk about a part of that is custodial risk. Do you have concerns there?
Yes, custodial risk is the question, what do you actually own? When you and I buy a stock today, we're not given paper certificates. Our assets are held as digital kind of assets. usually in a broker's account somewhere. It's not like I have some kind of digital storage here in my house and that's where the quote unquote electronic shares are held. Custodial risk is the idea that if the financial institution who is sitting on those things for you goes out of business, what do you do with your money? We had a taste of this with MF Global a few years back. MF Global went out of business, and a lot of traders and people who were using them as a broker dealer couldn't get out of their trades because the bank just froze everything. So that's really the question: is what do you actually own? This is part of also the issue with physical cash. This is why the central banks hate physical cash so much, because the custodial risk is not existent. If I take cash out the bank and put it in a safe in my house, it just sits there, the end. Whereas if the bank blows up while my money's in a deposit, there's the potential for a bail-in, such as we saw in Cyprus and elsewhere. So yes, custodial risk is a huge issue. And because it's been, the financial system's been sort of just maintained through these policies for so long, most people don't even know it. In fact, the SEC did an analysis of investment advisors in this country. I think they looked at about 400 firms. They found that 30% of them failed to understand basic custody requirements for an investment advisor firm, meaning that the firm itself didn't even know the basics, regulations, and requirements for them to maintain proper custodial risk should an event actually affect their ability to get transactions to their clients. So it's really staggering. You're talking about almost 1 in 3 of professional investment advisor firms, not individuals, but firms, not even knowing how this is supposed to work. So yeah, custodial risk is tremendous. That's why in many ways gold and physical cash is so appealing, because you sit on it. The custodial risk is next to nothing other than the potential for the physical cash losing value if they should decide they're going to ban it in some way.
We do a lot of work at the Financial Repression Authority on risk mitigation, and the list in the grid, which is open to the public on our site, shows we're upwards north of 18 different areas of risk that you seriously have to look at today, custodial risk being one of them, to properly make any kinds of investment decisions. But I will make the comment, the safest of all of those seems to be precious metals, but even they come with various types of risk, mostly taxation, government regulations, changes in the laws. So we have to break now. Graham, can you tell our listeners how any last comments?
Sure. If you're interested in finding out more about what we do and having a look at our research, we have a free e-letter called Gains Pains Capital. It's www.gainspainscapital.com. It's completely free, no charge. We publish articles once a day during weekdays. We're also on Twitter, and then our firm is called Phoenix Capital Research. You can see us at phoenixcapitalresearch.com. And again, we publish investment newsletters, investment reports telling people where to look and where to invest. But we don't manage funds. We don't broker deals. I myself, on a personal basis, do consulting in terms of helping people with what they're looking to do. But the firm, Phoenix Capital Research, does not.
Any last comments for our listeners?
Common sense is probably your best defense against what's going on right now. If it doesn't make sense to you, there's a reason. Don't let any reporter or central bank or anyone else tell you, well, this is just normal. This is how it is this is how it's going to be from now on. Just be sensible. Do things that make sense. Look out for yourself. Look out for your loved ones. No one, I hate to say it, sounds very nasty, but unfortunately no one's got your back. They just won't. When push comes to shove, it'll be much more likely for them to seize deposits to bail in a bank than it is for central banks and regulators to say, hey, we actually don't know what we're doing. We're all going to quit our jobs.
Well, as Will Rogers said about common sense back in the 30s, and the last time we were in these kinds of situations, he says the most uncommon thing is common sense.
Absolutely.
And that's so. Don't necessarily listen to what everybody's telling you. Do your own research, do your own digging, and use your own common sense in here. We have to break, Graham. Thank you for the time. Great. Sorry to bounce around so many subjects, but there's so many things to talk about, and I really encourage our listeners to follow your work. I think you're up on Twitter now too, right?
That's right. We're on Twitter. I think it's Gains Pains Capita, without the L at the end. But if you go to Gains Pains Capital, our e-letter, you'll see the Twitter feed there.
Talk to you again.
Take care. I look forward to it.
Bye-bye.
Bye.